Hello and welcome to this ET Now special. I'm Nayantara Rai. In the run-up to 1st of February Union Budget 2022, we are getting you a special of what India Inc. wants with Industry Chamber CII. Joining me is the A-list of CII, the Secretariat, President TV Narendran, also the top boss of Tata Steel. We are also being joined by the CII Vice President, Sanjiv Bajaj, and the top boss of Bajaj Finserv, and of course, Mr. Chandrajit Banerjee, the main person you need to know at CII. Thank you so much, gentlemen, for joining us today on ET Now. Thank you so much. TV Narendran, I'll come to you. You know, as CII President, can you tell me, is India Inc. expecting a lot in Union Budget? Just give us a sense of what the expectation is, and are you expecting more than anything else for it to be a status quo budget or a budget that can do something and really give a booster shot to growth?
Thanks, Nayantara. I think from CII's perspective, we certainly want the government to continue to do what it promised in the last budget, which is to spend big on infrastructure. I think that's important to get the demand growing in the economy. Private sector investment is likely to pick up over the next few months. It's already started picking up. We also want the government to do more on the consumption side. Household balance sheets have been impacted by the pandemic. People have spent more on medical expenses than they planned to. And you had job losses and salary cuts in many sectors, particularly the high contract sectors. So as something more to prop up the consumption, which is a bit fragile, so that we can go back on track to a 9.5% growth for the next few years.
We are, of course, also recording this after we've seen, the IMF actually come out with a report to cut down India's economic growth forecast. And with that, Mr. Bajaj, I'll come to you. You know, Mr. Narendran saying the expectation is high to boost consumption. How is it? Like via tax cuts?
So, Nayantara, what we really see is that in the last 2 quarters, our economy is slowly humming back to levels for most sectors that were at pre-pandemic levels. We've also recently done a survey with members, and more than half the members are getting into a new capex cycle. So the tailwinds are already underway. Of course, we are in the third wave of this pandemic. I believe that this is under reasonably good control, but we have to make sure we keep ourselves prepared for the next possible wave so that we minimize disruption each time from whatever we learn from the earlier wave. And keeping in mind that these are still green shoots that we are seeing on capex right now, we hope that the government continues with its capex plans, its divestment plans. So combination of these is what creates confidence to the common man. When he sees that things are on the health side under control, when he sees new investment coming in, which means employment comes in, this is what will create that consumption cycle to grow and grow at a steady pace, not with the kind of volatility that we have seen understandably in the last year and a half. So that's why it's not about any quick wins, but it's more about steady investment, which will help us then get into a steady consumption cycle.
You know, since you brought up that survey, let me take that question across to Mr. Banerjee, CB as he is popularly called. Talk to us more about this. It's an annual survey that is put out by the CII to get a sense of where the sentiment is among the CEOs and the top companies in India Inc. Would you say that confidence index is showing a big uptick this year as opposed to last year or even the year before that when we did see the pandemic breakout? Can this really be that year when we see the change, the capex cycle really change, for which the green shoots are visible that Mr. Bajaj was just talking about?
Yeah, so thanks Nayantara. What we have seen in the latest round of the Business Outlook Survey, what we call the CII PCI, that's risen to an index that we look at 66.8, and from the year for the quarter of October December. Now, to give it a meaning, it is recording 66.8 as against 62.8 6. So you can see the increase, and that's a continued uptick, signifying that sentiments from all the respondents, which are the member firms and member companies, are about the overall economy and their sector and their industry, of course, that's remaining pretty much upbeat and pretty much improved over the last quarter. And that is given the less sort of obviously we see the Omicron being much less virulent. And the third wave, definitely there's a feeling that it will have much lesser impact. So that is one. And of course, as you know, we have been talking about lesser restrictions, etc., etc. But what it means really, when we were analyzing it, that given the recovery seen that we are so far this year, it's good to note that a majority of the respondents foresee a noticeable improvement in business for FY22. And more than 60% of the respondents have revealed that they expect consumer demand and capacity utilization to improve beyond the pre-pandemic levels of FY 2022. And you talked about investment. Investment activity, as we are seeing in that survey, that is expected to recover with more than half of our people who have responded. That's about 55% anticipating an pickup in investment in FY22 vis-a-vis FY20. So with the improvement sort of in demand, business condition, most of the respondents also anticipate something very important, and that's job prospects in the sectors across the sectors during FY22 against FY20.
Okay, so I'll build on that with Mr. Narendran now. So, Mr. Narendran, you just heard the summary of the survey put together for us by Mr. Banerjee. But if I could build on that more, we are also talking at a time when we are seeing a big threat from inflation. We've been hearing about the super cycle of the commodities, the super cycle of the commodities. A few months ago, you yourself personally had said there is a case for the government to announce a 3 lakh crore rupee economic stimulus package. Right now, what is the need of the hour, given the fact that the common man is burdened by inflation, and also you have India Inc., which is seeing its margins being squeezed out by inflation?
So, Mehta, there are a couple of dimensions to it. One is a little bit more short term, which is driven by the fact that the economies across the world, including in India, recovered faster than most people had planned for and most supply chains were ready for. So that led to inflationary pressures across commodities, including in freight rates and everything else. Some of that has started settling down over the last few weeks and a couple of months, and it's just expected to settle down. The second part is a little bit more to do with liquidity and to do with availability of money and that fueling asset inflation and everything else. So I think CII stands by its recommendations that, both on the investment side, which the government needs to support, also needs to be supplemented by support on the consumption side. And that's why I said the first point, we need to continue with the Manrega schemes. We need to help sections of society which have been impacted by consumer inflation because that's going to be there. It's still at the higher end of what RBI would like. And so that's something that we need to address. And I think going forward, some support for the MSMEs, particularly those MSMEs who have not come out of the cycle well, some contact for the high contact sectors which employ about 10 million people, and also promotion of sectors like tourism, etc., where employment is generated, so that the lower ends of society also have incomes which can, to some extent, mitigate the impacts of inflation as it settles down.
But Mr. Bajaj, the union budget is also going to be tabled at a time when there is going to be so much uncertainty, and never more than ever will we need that jugalbandi between the center and the RBI to continue. Whether it is inflation, whether it is the end of the liquidity, excess liquidity program, whether it is where we're seeing crude oil prices, the super cycle of commodities, Mengai. How, nobody wants the finance minister's job at a time like this, but what will be the best way to balance it?
That's quite a loaded question, and that's not an easy, straightforward answer. And but if you can see, the the finance ministry representing the government, and the RBI has actually been working in quite a collaborative way right through the various waves of this pandemic. The messaging is consistent, which is very important. We have seen both monetary and financial stimulus at various points of time. A lot of it is continuing. We do know that the excess liquidity that not only India didn't put that much of it in, but the world, especially the Western countries, or the developed countries, what they've put in, has to eventually start normalizing. And this is the situation that we are in. We can see the impact on our markets in the last couple of weeks as a result of that. I'm sure the experience that is there at the RBI, along with the Finance Ministry, they would provide one guidance, which is what they are telling us, that how they're expecting to normalize, and secondly, do it in a gradual way, so that you don't have the taper tantrum period that we last had nearly a decade ago, but change happens gradually. There will be then unknown factors, whether it is an additional wave, whether it is oil prices, our single largest reason for domestic inflation. So there will be these factors. You have to just plan as you move ahead. But I hope that the collaborative effort continues. No reason why it should not. Second, the guidance is provided so that we all know which way we are heading. And thirdly, a gradual normalizing takes place, keeping in mind healthcare, keeping in mind minimizing disruptions for whether this wave or a possible future wave.
So, Mr. Banerjee, what has been the recommendation of the CII? You every year do give a memorandum of sorts to the government of India. We have once again seen Prime Minister Narendra Modi meeting with all of you and leading industrialists. This, of course, besides the regular budget meetings that take place with the Finance Ministry. What has been the recommendation that ignore fiscal deficit, loosen the purse strings, but at the same time we can't go too much off that path of fiscal consolidation, right? So that it doesn't bite us in the future.
Absolutely, very important point. And obviously, we need to keep focusing on growth at this point in time. That's going to be very critical. But given that both direct as well as indirect tax collections has been pretty strong, as we know, the government looks likely to meet its fiscal deficit. I'm quite confident for this year. And there has been a strong revenue collection, which you are pretty much aware of. It's raised more than about 9,000 crores in terms of disinvestments. And as far as the government has so that is something which worries me. That's a shortfall. That's a shortfall from the previous target. But the receipts has gone up pretty much well. So what I think is going to be important is, if you look at FY23, it would be quite important for the government, and that's what we have been saying, to finally balance growth as well as fiscal prudence. As a sharp sort of a consolidation would absolutely hurt the type of recovery that we just now spoke about when we were talking about the survey. And we expect the government to maintain, therefore, its focus on infrastructure development, infrastructure investment, which Narendra talked about, and also allocate more resources towards the national infrastructure pipeline. And therefore, what I would really think, the reduction in fiscal deficit target for FY23 definitely set to be modest, and the target could be somewhere between, if I can say, 6.3 to 6.4 of the GDP. And most of the reduction really could be financed through more aggressive asset monetization, disinvestment in PSUs, privatization of the two state-owned banks, which was announced in the last year's budget. That really would allow the government to continue to step up capital expenditure to support the recovery, which we all talked about during the course of this talk with you.
Okay, so CII making a case for that kind of a fiscal deficit target, loosening the purse strings, keeping a firm plan as far as infrastructure spending goes. But Mr. Narendran, isn't it also time now that India Inc. Does its bit as far as turning around the capex cycle goes? We started to see maybe green shoots of that, but now there really is no excuse, right? Because even the bank's balance sheets we've seen have cleaned up. You have a case where interest rates in the US are going to go up. China is trying to be aggressive by cutting interest rates. So it's time India Inc. also does it best.
Yeah, Andhra, that's right. But if you see what's happening, I think the conditions are just right for that. So normally private sector investment comes back when there's demand growth, which is happening now. When the profitability improves, which is also happening now, which is not the case maybe 3-4 years back. When balance sheets are deleveraged, which is also happening now. Right. So in some sense, capital intensive sectors which had poor balance sheets, poor profitability have turned around, and hence you will see sectors like metals, etc., where there's been a lot of announcements on investments. If you look at investments over 8-10 years back, it was largely chemicals, metals, and power. Of which chemicals and metals is coming back. We're clearly seeing that. Power is changing, right? 10 years back, it was thermal power plants and all that. That's no longer where the money is flowing into. It's more green energy and renewables, etc. So we are seeing that investment cycle come back, and I'm confident, and that's why we feel that if the government continues infrastructure spend as it has promised to, I'm sure you'll see the capex cycle come back in private sector. We're seeing that amongst our members. Most of them are at high capacity utilization and have announced that over the next year they will be reviving the capex cycle.
So, Mr. Bajaj, simply because of what you do and lead at Bajaj Finserv, you really have a pulse of what's going on. Give us a sense of, is there now less pain on ground, especially when it comes to service industry? Are you seeing an uptick in consumption? And I'm going to put you in a spot, and you share with us 3 ideas that the union budget can have to see a big consumption uptick.
That is really putting me on the spot, but let me first start by saying that yes, from about July or so, we are seeing steady uptake on the consumption side, both rural and urban. December onwards, middle of December onwards, as this third wave started kicking in, we're seeing some amount of slowdown, especially on the rural side. But most metrics are working well. So our performance, our risk metrics are all working well right now, which is a good sign. I think part of the slowdown we are seeing is that for consumption, people will be cautious. But more importantly, the fast spread of this variant means that a lot of people have to be at home for that 1 week period. So just physically, we are finding that the industry does not have enough hands together to man business. And in many cases, this is what healthcare is also telling us. Hospitals are telling us that it's not the severity of the wave, but for a period of time, people are just not available. So I think that's causing the slight reduction on the consumption side. But I'm confident that from second half of February or March, this will improve. What can we do? 3 points to get us back to steady consumption. One is, as I mentioned earlier, it's psychological for the consumer. Hence, like the government, along with the private sector, has prepared well for this wave. Let's continue preparing for a next possible wave. That means open up boosters to everyone. We have got enough production capacity of vaccines. Do the quick studies for mix and match. Bring in the new vaccines from outside. Let's get proactive on therapeutics to see what works, what doesn't work. We can't just go back to life as normal every time a wave recedes. We have to start preparing for the next wave. And as I said, the government has done a good job this time, but let's not assume we won't have another wave. Because the more confidence we create, that's when people go open up their purse strings. So to me, that's the first thing to do. Second is, while we are, as we've discussed, seeing green shoots and we're going to see capex investment coming, by the time the money gets converted into equipment, production capacities increase, it takes time. So government must continue with their own divestment, must continue with their investment in infrastructure. So that continues to give us tailwinds. So to me, that is the second thing to do. The third is really to start preparing not just for the next 12 months, but beyond that. And hence significant upgradation in healthcare spends, continued investment on infrastructure. Let's start preparing ourselves for a much larger India, hence education, skill building, focus on those areas, focus on innovation. Climate change is going to be a challenge, but it's also going to provide tremendous opportunity. How can we as a country lead there, not just by copying what the West is doing, but innovating and creating our own solutions? So my third point is not something that will give us immediate result, but that creates then a longer term pipeline.
Okay. And Mr. Bajaj, you will be one of the best people to answer this. Given the turnaround that we're seeing as far as the banking sector goes, the cleanup of the balance sheets, we've seen really good results by some of the private sector banks as well. Should the budget have anything as far as recap of banks go, or consolidation of banks goes, the banking act that had to be amended?
Very clearly, we can see private sector banking results, NBFC results have been very strong the third quarter. They are raring to go, and you will see the benefits coming to other sectors because of that. On the public sector side, we will still see many of the results. It is still mixed. Wherever immediate support is required by investment, we would urge the government to do that. But more importantly, you have to make them competitive. You have to give them freedom to pay the right salaries, to fix their own strategies. And for that, government has to divest. So we hope that we see these two divestments in public sector banks and one public insurance company. That is the direction to take now. And then the market will bring its own competitive benefit. So that's what I hope that we will see a very clear continued road plan in the budget.
Okay, so we've set the agenda, we can call it that, for 1st of February, and this star panel will be back on 1st of February on Union Budget Day right here on ET Now. With that, I'd like to thank all three of you for joining us here in the run-up to the budget. See you again on the 1st.
Thank you. Thank you.
Thank you.